Hello everyone, welcome to the market opening bell for Monday, March 2nd, your 10-minute guide to the stock market. The Hang Seng Index opened 66 points higher last Friday at 26,447, dipped to a low of 26,375 in the early session, down 6 points, then climbed as much as 320 points in the afternoon to reach 26,701. Before closing at 26,630, up 249 points or 0.95%. The Hang Seng China Enterprises Index rose 45 points or 0.5% to 8,859. The Hang Seng Tech Index gained 28 points or 0.6% to 5,137. Total market turnover reached $288.4 billion, the highest in 3 weeks. Southbound funds net bought 14.997 billion Hong Kong dollars worth of Hong Kong stocks. Among them, the net purchases included Tracker Fund at $8.385 billion, Hang Seng China Enterprises Index ETF at $2.482 billion, CSOP Hang Seng Tech Index ETF at $2.039 billion, Tencent Holdings at $1.232 billion, Xiaomi at $343 million, and Alibaba at $338 million. On the sell side, net sales included Yangtze Optical Fiber and Cable at $505 million, Kuaishou at $381 million, Hua Hong Semiconductor at $272 million, SMIC at $228 million, and Drinder Group at $103 million. According to statistics, Southbound funds have now net bought Xiaomi for 6 consecutive days, totaling $3.568 billion. Last week, the Hong Kong market showed a pattern of early gains followed by a pullback, with support found at lower levels. The Hang Seng Index mainly oscillated between 26,300 and 27,000 points. For the full week, the Hang Seng Index rose 217 points or 0.8%. The China Enterprises Index fell 100 points or 1.1%, and the Tech Index dropped 74 points or 1.4%. Looking only at February, the Hang Seng Index fell a cumulative 756 points or 2.8%. The China Enterprises Index dropped 4.9%. The Tech Index plunged around 10.1%, underperforming the broader market and recording its largest single-month decline since January 2024. Apart from drags caused by corporate earnings and talk of an AI bubble, tech giants' heavy spending on AI-related red packets during the Lunar New Year and also intensified competitive pressure beyond the food delivery sector. Technically, the Hang Seng Index narrow range consolidation may see a breakout as we enter March. It's worth noting that the index appears to be forming a complex head and shoulders top pattern, currently building the second right shoulder, with the neckline around 26,300 points. If the neckline is decisively broken, the measured downside target would be 24,500 points. Only a move above 27,400 points with a firm hold there would invalidate the bearish head and shoulders formation. On the mainland, the 3 major A-share indexes opened lower on Friday morning but diverged in the afternoon. The Shanghai Composite rose 16 points or 0.4% to close at 4,162. The Shenzhen Component Index gained 27 points or 0.2% to 14,503. The Chinex Index fell 9 points or 0.3% to 3,354. Combined turnover on the Shanghai and Shenzhen markets total 2.54 trillion yuan. Last week, the mainland market traded for 4 days and showed a mixed oscillatory pattern. The Shanghai Composite rose around 2%, the Shenzhen Component Index gained nearly 3%, and the Chinex Index climbed more than 1%. For the month of February, the Shanghai Composite rose 1.1%, the Shenzhen Component Index rose 2%, marking 3 consecutive months of gains for both. The Chinex Index, however, fell 1.1%. The renminbi central parity rate against the US dollar stood at 6.9228, unchanged from the previous day. To promote the development of the foreign exchange market and help enterprises manage exchange rate risk, the People's Bank of China announced that starting this Monday, the foreign exchange risk reserve ratio for forward foreign exchange sales will be cut from 20% to 0, aiming to moderate expectations of renminbi appreciation. On last Thursday, trading volume in US dollar renminbi options surged to its highest level since Donald Trump's re-election in November 2024, with market funds clearly betting on renminbi strength, some even wagering on a 5% appreciation that could push the exchange rate to 6.5. The previous 20% reserve requirement meant that for every $100 of forward sales, banks had to lock up $20 of interest-free funds with the central bank. That cost was usually passed on to enterprises. So lowering the ratio reduces the cost of buying dollars, thereby increasing demand for foreign currency and gently applying the brakes on RMB on renminbi appreciation. After the PBOC announcement, the offshore renminbi quickly fell more than 100 points against the dollar. The Political Bureau of the CPC Central Committee held a meeting stressing the continued implementation of a more proactive fiscal policy and an appropriately accommodative monetary policy. It called for sustained expansion of domestic demand, optimization of supply, improvement of incremental growth while revitalizing existing stock, development of new quality productive forces according to local conditions, deeper advancement of the nationwide unified market, and focused efforts to stabilize employment, enterprises, the market, and expectations. The goal is to promote qualitative improvement and reasonable quantitative growth in the economy, maintain social harmony and stability, and secure a strong start to the 15th five-year plan. Investors are closely watching the National Two Sessions opening on March 4th, expecting more concrete signals on the 15th five-year plan and economic growth targets. This will be one of the key factors determining whether Hong Kong stocks can regain the 27,000 point level in March. On February 26, 2026, China's State Administration for Market Regulation issued two new regulations targeting online catering and food sales, which is the provisions on supervision and management of food safety subject responsibility by online catering service operators and related sales rules, which will take effect on June 1st, 2026. The rules focus on ghost kitchens and platform accountability. Platforms will no longer be mere matchmakers, but will be positioned as the first gatekeepers of food safety. Compliance costs for delivery platforms will rise, and the cleanup of ghost kitchens may cause short-term order volume declines. Although the compliance burden is heavy, if the rules can effectively curb involution-style low-price competition and subsidy wars, they will in the long run help platforms shift from pure scale expansion to quality-driven growth. Mainland auto companies have successively released February sales figures, which remain weak month on month, with most recording declines. The 2026 Chinese New Year holiday fell in mid to late February, significantly disrupting domestic production and retail activities. Soft demand and adjustments to subsidy policies also kept sales under pressure. Geely Automobile sold 206,100 vehicles last month, up 0.6% year-on-year, but down to 23.7% month-on-month. Zeekr delivered around 23,800 units, surging 70% year-on-year, with almost flat month-on-month performance. BYD delivered 190,100 vehicles last month, down 41.09% year-on-year and 9.46% month-on-month. Exports of new energy vehicles total 100,600 units, while domestic sales were only about 89,590 units, a sharp 65% year-on-year drop. Chery Automobile sold 146,100 vehicles, down 14.8% year-on-year and 23.7% month-on-month. Great Wall Motor sold 72,500 vehicles, down 6.8% year-on-year and 19.6% month-on-month. Leap Motor delivered 28,000 vehicles, a steep 47% month-on-month decline. Li Auto delivered 26,400 vehicles in February, up a slight 0.6% year-on-year, but down 4.5% month-on-month. The company plans to launch the all-new second-generation Li L9 in the second quarter. NIO delivered 20,700 vehicles last month, up 57.7% year-on-year, but down 23.5% month-on-month. Xiaomi Auto delivered more than 20,000 vehicles last month, flat year-on-year, but down a sharp 48.7% month-on-month. The next generation SU7 electric car is scheduled for launch in April and is currently preparing for mass production. Xpeng delivered 15,200 vehicles last month, down 49.9% year-on-year and 23.8% month-on-month. Meanwhile, the all-new Xpeng P7 Plus began global deliveries in February, with the first batch shipped to 18 countries. The company also previewed the second-generation VLA, expected to launch officially in late March. U.S. January producer prices PPI rose more than expected, fueling inflation worries and triggering selling in U.S. stocks last Friday. The fear gauge fixed index climbed 1.23 points or 6.6% to 19.86. The Dow plunged as much as 820 points or 1.7% at one point, eventually closing down 521 points or 1.1%. at 48,977. The Nasdaq fell 210 points or 0.9% to 22,668. The S&P 500 dropped 29 points or 0.4% to 6,878. The Nasdaq Golden Dragon China Index, reflecting Chinese concept stocks, fell 133 points or 1.8% to 7,277. Hong Kong ADR trading suggests the Hang Seng Index will open 168 points lower this Monday at 26,462. To sum up, the three major U.S. indexes last week failed to sustain the previous week's gains and fell between 0.4% and 1.3%. For the month of February, the Dow edged up 0.2%, extending its winning streak to 10 months, while the S&P 500 and Nasdaq declined roughly 1% and more than 3% respectively, marking the largest single-month drop since March last year. The iShares expanded tech software sector ETF fell nearly 10% in February and is already down almost 23% year-to-date. UK mortgage finance company Market Financial Solutions (MFS) entered bankruptcy proceedings last Wednesday. Markets fear the collapse could inflict losses on bank stocks, sending several lenders lower. Jefferies plunged as much as 9.3%. Morgan Stanley fell 6.2%. Bank of America and Barclays dropped around 4%, and Wells Fargo declined 4.6%. The firm has been accused of financial irregularities, fraud, and double pledging assets, using the same assets to borrow from multiple institutions. Creditors warned of a potential guarantee shortfall of up to $1.3 billion, following J.P. Morgan CEO Jamie Dimon's cockroach theory warning. This incident may signal hidden risks throughout the credit system, reminiscent of the environment before the 2008 financial crisis. Major tech stocks generally weakened. Nvidia fell another 4.2%, Apple dropped 3.2%, while Tesla lost 1% while Tesla and Microsoft lost 1 to 2%. Amazon and Alphabet bucked the trend, rising more than 1%. Cloud service provider CoreWeave tumbled about 19% to $79.56 per share after its fourth quarter loss exceeded Wall Street expectations, and its first quarter revenue guidance plus full year adjusted operating margin outlook also missed targets. At the same time, the market grew concerned over its massive capital expenditure plans. The company intends to spend 30 to 35 billion US dollars in 2026, far above the expected 26.9 billion US dollars. Block surged nearly 17% to $63.70 per share. The payment services company behind Square and Cash App announced on Thursday that it will cut 4,000 jobs, roughly 40% of its workforce, citing disruption from official intelligence, while simultaneously raising its 2026 financial guidance. Block's large-scale layoffs have once again drawn Wall Street's attention to the impact of AI development. If more companies follow suit, it could validate the scenario outlined by Citrini Research last Monday, which projects that widespread white-collar job cuts could push the unemployment rate to 10% by 2028. Netflix originally had 4 days to decide whether to match the latest offer from Paramount Skydance, but within less than a day, the company issued a statement on its website saying that following the new offer would make the deal no longer attractive, and formally announced that it was abandoning the acquisition of Warner Bros. Discovery. After withdrawing, Netflix will still receive a $2.8 billion US dollars termination fee, paid not by Warner Bros. Discovery but by Paramount Skydance. Netflix also disclosed that it will invest $20 billion US dollars this year in film and series production. After announcing the withdrawal, Netflix shares jumped more than 13%, Paramount Skydance surged 20.8%, while Warner Bros. Discovery stock fell 2.2%. US January PPI rose 0.5% month-on-month, above the market expectations of 0.3%. Core CPI rose 0.8%, also well above the estimated 0.3%, showing that inflationary pressure remains sticky. Tensions in the Middle East have escalated, with a large backlog of oil tankers outside the Strait of Hormuz. Globally, up to 20% of daily oil supply passes through this choke point, including crude exports from Saudi Arabia, Iraq and the UAE. Any disruption to the shipping lane would support higher oil prices. However, OPEC Plus reached an agreement in its March 1st video conference to increase crude output by 206,000 barrels per day starting in April, aiming to ease potential supply disruptions and price spikes from geopolitical conflict, with the market worried oil could retest $100 US dollars. The move also marks the formal end of the production freeze that had been in place for the first quarter of 2026 due to seasonal demand weakness and overall oversupply concerns. Our stock pick today is China Resources Power, stock code A36. China Resources Power continues to focus on the dual carbon targets, closely aligning with the development plans for the new type power system. The company is actively planning for rapid expansion in wind power, photovoltaics, and other new energy sources, driving the energy industry toward accelerated green and low carbon transformation. In the first half of 2025, the group added approximately 4,839 megawatt of new grid-connected installed capacity from wind power and photovoltaics combined. As of 30th June 2025, the group's managed grid-connected installed capacity stood at 88,931 megawatt, while total equity grid-connected installed capacity reached 78,094 megawatt. Of this, thermal power accounted for 39,139 megawatt in equity grid-connected capacity, accounting for 50.1%. Wind power, photovoltaics, and hydropower together reached 38,955 megawatt, accounting for 49.9%, up 2.7 percentage points from the end of 2024. Specifically, equity grid-connected wind power capacity was 25,549 megawatt, and equity grid-connected photovoltaic capacity was 12,966 megawatt. In the first half of last year, the group secured 5,874 megawatt of renewable energy development and construction quotas, including 3,996 megawatt for wind power projects and 1,878 megawatt for photovoltaic projects. In 2025 year-to-date, China Resources Power's subsidiary power plants recorded cumulative electricity sales of 226,789,826 megawatt hour, up 7% year-on-year. This included 53,702,309 megawatt hour from subsidiary wind farms, up 16.4% year-on-year, and 13,202,002 megawatt hour from subsidiary photovoltaic stations, up 55.5%. With the accelerated construction of data centers, electricity demand, particularly for highly stable baseload power, has increased significantly. On the policy front, the General Office of the State Council recently officially issued the implementation opinions on improving the National Unified Electricity Market System, which clarifies the multi-dimensional value of power resources, including energy value, regulation value, environmental value, and capacity value, will be fully reflected through market mechanisms. The market expects this to drive profit improvement and valuation re-rating for the power sector. At the same time, the country is accelerating the establishment of a green electricity consumption system, such as green certificate trading, providing institutional guarantees for the long-term absorption of green power. China Resources Power's first half 2025 results were impacted by electricity price volatility, with net profit declining 16% year-on-year to 7.87 billion Hong Kong dollars. Profitability is expected to gradually recover from the second half onward. The current PE ratio is approximately 6 to 7 times, which is low relative to historical averages. The forecasted dividend yield remains attractive at 5% to 6%, offering investors stable cash flow. Recommendation suggested buy at 18.4 Hong Kong dollars with initial target $19.4, next target $20. Stop loss at $17.5. I do not hold the above stock.